Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Thursday, June 23rd, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by a fellow blockhead trader, Viper XL 007, and we are just going to take a look at what's been happening in the markets and what is up with our portfolios and our game plans in the coming weeks, days, and potentially even months. But before we hop to that, I want to give a shout out to our Discord, link in the description below. We do stream this live in our Discord. Additionally, you can drop in there anytime. It's free to join, and you can say hello to myself and any of the other Blockhead traders. Let us know what you're trading. Let us know what you want to hear about. But let's hop to this week's content. Viper and the markets have been quite the whipsaw action. Last week, we had the FOMC meeting. That is the federal meeting where they set the interest rates and they hike them 0.75%. We talked about that a little bit last week's episode. And since then, in this particular week, the chairman, Jerome Powell, basically testified in front of Congress. That's mostly after they do their meeting. Then Congress calls him in the next week and they ask him questions about, what are you going to do, Mr. Powell? Given all these different scenarios. It's largely a way for you to get a little bit of context around the decisions that go into that meeting and things that they kind of consider. He did give, when they do announce the rates, he also gives some comments from the Fed meeting itself. This is just where the different congressional members can kind of ask him questions. And after the initial rate hike, on the day of the rate hike, the markets really responded well, and then they nosedived the day after that, and really shares just kind of plummeted. This week, we started off really strong on Monday. We've had pretty decent positive pressure upwards. I wouldn't say quite rocket fuel yet, but generally the markets were pretty receptive to a lot of what he was saying to Congress and responding to the questions. And I read some of the stuff. I didn't watch any of the comments live. And the key takeaway that I got from the different articles that I was reading is he was essentially asked by Congress about, what are you going to do with interest rates if the economy starts to really contract? Because this is the balancing act that the Fed has to always keep in mind, is this economic growth and expansion, which is typically achieved by lowering rates and kind of keeping inflation under control, which is typically done by raising rates. And if you get too much contraction, you can drive the economy into a recession, but you might still get inflation under control. And the other way around, if you keep economic activity too hot, then you get inflation that can spiral up out of control. The worst thing you can do in this situation is when your rates are low, but you are currently in an economic recession and you still have high inflation. Because at that point, you can't really stimulate the economy because your inflation is already out of control. But if you try to get inflation under control, you will further damage the economy. I believe this is what's known as a stagflation. And when the chairman was kind of asked what would he do when the economy started showing signs of weakness, he basically said, our job is to do price stability, and we have to give preference to getting inflation under control. So he essentially said that he was going to strongly consider not backing off on rate hikes if inflation was still out there. In general, I think the markets have responded well to that, likely because that means inflation will be kind of kept under control. And even in the world of crypto is a great example of what craziness can happen when inflation just spirals out of control. And so the Fed really is kind of viewing that as their primary mission. and they show no signs of relenting on pushing the brakes.
Yeah. So call me crazy, but I feel like, and maybe this is just the power of narrative and, just something to talk about or whatever you have. But I'm like, I mean, at the peak of rate decreases, we went to zero, correct?
Yeah, essentially zero. I mean, they say between 0.5,
Yeah.
but yeah, it was pretty much
So,
nothing.
like, I mean, even when that's happening, like, it has to be on the back of everybody's mind. Like, we can't stay here. We have to go up. And so it like, and what I mean by the power of narrative, I guess, is it perplexes me when people are, whether they're outright frustrated or angry, or whether it's just kind of, sad or whatever about inflation, but then they're also mad about rates going back up. And they combine the two as like the gripes of the day of like, oh, inflation's crazy and rates are going up. I'm like, well, these are, you can't take both, right? Like, these are mutually exclusive things that you're upset about. And like, we kind of all, like, I'm not going to say we all saw this coming. And like we've talked about on previous episodes, like the impact of when it hits is just never predictable. But at the same time, like, we all saw the same thing. We all saw this go to zero. Like, this has to come back up. And so to me, like, the market's responding positively so far, seems to be like that kind of cuts through, like, the adage money talks. Like, that kind of cuts through. This is what's important. Like, the investment money knows that this needs to happen. And so here it is, and things are going up and yada yada. But it's, I don't know what to make of all of it, but it's just kind of an interesting observation I've made as we're trucking on through.
Yeah. So one interesting thing that I think is kind of more from your and I perspective is like, one, okay, we haven't traded in the markets for very long, but for pretty much our entire lives, interest rates have only gone down. So that's one aspect. Like, a lot of people don't really know what's it like to go get a mortgage at 20% interest rate. I think our parents probably were in double-digit mortgage rates, at teens for sure, maybe even in the 20s when they bought their house. The other part, I think, what the market is so volatile isn't as much of the rate movement per se. I think it's all about trying to understand how to value the companies given the future economic environment. Are they priced correctly? Are they priced too expensive? And I think nobody really knows very clearly what the consumer might do, because in high interest rate times and recession times of the past, like, we've never had such a strong labor market. And that is where I think a lot of people are perplexed because the labor market is so strong. There's thought that could prop up spending for a period of time before you start to get the impact to the earnings of the companies. And that's what I think a lot of the price discovery is around, is when's that going to hit the share price and the earnings of the companies?
Yeah, that makes sense. So, yeah, I've still, as I've discussed on previous episodes, still haven't reacquainted into equities, and was, taking that detour through some crypto land stuff, which we'll get to my plans on equities here in just a minute. But there was one thing crypto related, because currently that's where at least my mind is at, that I wanted to touch on. And that's, of course, related to Avalanche, which I feel like, just full disclosure, we just keep saying it, that we both are, but I am, invested in the Avalanche ecosystem. And so that is why I'm focused on it, but it is also, important information, that there is that investment bias there. But kind of what I wanted to focus on here is just briefly talking about, just the things that are being built that you know, they're not, I don't want to say they're like game changers of this is it, this is everything, but it's just, to me, the space has been what's kept me involved in the space for the past 8 or 9 months or however long it is just the Wild West nature of it, the, weeding through the noise, of all these different, crap coins and all this other stuff, and like seeing what people are building in this space that, can it survive? Maybe, maybe not. This great economic experiment all over again in a high speed rate. So I'm always interested when something quote unquote major happens. And so here we see this Avalanche Bridge adds native Bitcoin support, which I feel like is kind of a big deal. But what it means is we've talked about before that Bitcoin is not a smart contract platform. It's just a literal store of value. That was the very first thing created, and it was created just to be a public ledger of people transacting this token that the fact and how they were using it was giving it value, and that's it. There's nothing else. And then obviously we talked about Ethereum comes on, changes the game with smart contracts and lets you do all the things we've kind of discussed so far. So up until this point, the whole thing of Bitcoin is it's just this digital gold of I just hold this and it gains value and it loses value and I sell it and I don't do anything with it. And there is this concept of wrapped tokens. And so there is a thing called wrapped Bitcoin where because all these chains are incompatible with each other. You can't, natively take Bitcoin and just go send it onto Ethereum, et cetera, et cetera. There's this concept of a wrapped token, which is just a token that's minted on a different blockchain. And that wrapped token holds the value of the thing that it's wrapped. So on Ethereum, there is a thing called wrapped Bitcoin, which is a way to use the Bitcoin value on Ethereum. So on the surface, this sounds very much like that. Well, wait, isn't this just making another wrapped thing? What I find interesting is, so the way the wrap tokens work are, if I have Bitcoin and I want to go on Ethereum and use my Bitcoin in some DeFi protocol or something, LP farm it, whatever, I send my Bitcoin to some custodial bridge that's set up. They actually take custody of my Bitcoin. And in the same instance, they mint this wrapped token and they send that back to me. And then I go use the wrap token however I want. When I want to unwrap it, I send the wrap token back to them. They go ahead and burn that wrap token, and then they send the real Bitcoin back to my Bitcoin address. And that's how we get in and out. So we're dependent upon other entities, these custodian protocols and things like that. And I'm not saying they're bad, but this is, supposed to be what? The world of decentralization. Being centralized again. And so what's happening here with this native Bitcoin support? So there's a new wallet and it's a Avalanche wallet. So you would use it to be on Avalanche like you've seen us do on previous episodes. If you have Bitcoin, your new Avalanche wallet actually has a Bitcoin address attached to it. So you can send your Bitcoin to your personal Bitcoin address that's tacked to this Avalanche wallet, and then using an Intel processor feature called SGX, which you can definitely look into. Very interesting stuff. Software Guard Extension is what it stands for. It's essentially a super secure enclave on the server chips that are executing this transaction, again, to maintain security, and you can't tamper with the code. But you're sending your native Bitcoin to your Avalanche wallet, and then that is wrapping it within your personal wallet. So you aren't, doing this custodial ownership of your Bitcoin in the interim. And then you can go on to the Avalanche network, and like I said, LP people will build all sorts of different protocols that you could use your Bitcoin. So it's not interesting as much for Bitcoin holders so much as what will people build now that this ability to use Bitcoin and essentially tap what is currently like a $325 billion market, which I laugh because that's Bitcoin and it used to be over $1 trillion just a few months ago. But it opens up this $325 billion market to do something with their coin that they're just sitting here holding. Whether they will or not, who knows? But I thought this was interesting and worth mentioning and worth looking into for more if you have any interest.
Nice. Maybe it will help make Intel relevant again.
Yeah, I mean, it's got to have something.
For those of you that haven't looked at Intel stock versus a lot of the other semiconductors, they are clearly lagging.
Which is odd.
So that's interesting news, Viper, in the world of crypto. Does this mean that you're playing more in crypto as far as your investments? The equities have really kind of backed off a little bit. Are you getting a little enticed to maybe come back into the waters?
Yeah. So I've kind of been, I haven't really mentioned it on previous episodes, but I've kind of hinted at it that it's on the back of my mind of, how and when do I get back in? Because as much as I would like to say that this was all part of the plan, that I pulled my equities into cash largely before the crash. I'm gonna be completely open and honest and say that was just dumb luck. I did mention it.
That was good luck. That was not dumb.
But hey, if bad things happen to us and we say that's a learning experience, let's debrief and figure out what happened. The same exact rules apply to when something good happens. Like, let's not get cocky and claim responsibility of it. Let's figure out what happened there. And so that's where I'm at, because before everything really crashed, it was starting to go down. And I think I mentioned on a previous episode that I was like, it's too hard to focus in both. I just need to simplify, keep things easy to maintain, whatever. So let me just for a second close out equities. And I was okay doing that because we did, like I said, start to get some retreat and things just weren't as easy, to just sell some naked puts and blast off and cool down and all that good stuff. So I felt fairly confident of all right, let's just cool this off, lock this up and wait. And then as things started to crash, and by no means did I start making money in crypto. That was crashing potentially even harder. But at least it was my much smaller bag that was crashing really hard. My much larger bag that is meant to be more stable and long-term was just frozen for a second. So it's been on the back of my mind, what now? How and when do I start to resolve this and get back in? Because I don't, even though equities have been crashing, I don't like the fact that I'm not there, even though it's crashing. The whole ideology of, you lose money if you're not in the market, no matter what's happening. And there's data points that I wish I would have researched a little bit, but, something to the effect of if you go all the way back to 1937 or 1940 or something like that, and invest $5,000, and what would you have today if you just never touched that money the entire time? Something crazy, I don't know, $1-2 million, something up there. And if you, over that time span, if you only left the market when it crashed, so 5 times, 5 of the major crashes, if you just left then, went back in, you would have something ridiculous like $50,000. It's just incredible disparity. And so exposure is good no matter what's happening, as long as you're on that long time frame horizon. Obviously, some 100 years, maybe not, but but what to do? So I'm going to try to capitalize on this. And the first idea the idea that I had to start easing back in is, if we take a look here, 2 ETFs that I'm kind of looking at, VOO and VTI. VOO is the Vanguard S&P 500 ETF, and VTI is the total stock market ETF. These, it just seems like an opportunistic time. Normally I don't have the kind of money that, you would want to throw into an ETF, these giant sums of money that, it's time to just go ETFs and just start cruising on very light, 3, 4, 5% returns, annual returns or whatever. But this feels like an opportunity worth at least an experiment of, we're in such a pullback here. So we're looking at the VOO. I mean, we've talked about this plenty of times, but I mean, we're off the top currently as of today. We're 20.6% down. We've talked in the past about possibly it could go as much as 32%. So it feels like of anything I could get into with fresh cash, that kind of DCAing, dollar cost averaging into these ETFs, which are on this significant pullback, feels like a decent way to start getting back in in a way where I don't have to worry about which company is rebounding, which company is not, which company, all these different things where before I pulled out everything, there were no ETFs in my personal portfolio. I haven't touched my 401k for all of this, so I guess technically I'm not out of equities. But before I didn't touch any ETFs because everything was up and to the right. And so you just, kind of threw money on the table and watched the charts and, grab this, grab that. And so I feel like now it's just a different mindset and a different time. And this is my approach to a different strategy. And then as we recover, either take profits off of these, or honestly, I'm hoping to just leave them and then slowly be bringing in more money. And when it gets to a more palatable season for buying individual underlying stocks and whatnot, then get back into that pattern. And I feel like this, in theory, should build up a pretty nice little recovery plan for myself.
No, for sure. I like this plan. I like the way that, you're kind of looking at it and saying, hey, I don't have a lot of attention span to give to this. I don't have a lot of time or to kind of look at nooks and crannies and things like that. But in general, I think you think the market is kind of going to go much higher or a good bit higher over the longer term. Like you're not making this trade say, oh my gosh, I'm gonna ring the register in a month or two. I think you're looking further out, and I think that's a very reasonable play and decent play to look into.
So how about you? What are you what wounds are you licking, or how are you handling the future and the next few months or so?
Yeah. No, so part of my strategy has always been to invest, at least sell options where I am confident in the underlying company. We did an episode. I'll link up above here in the video. You can click on it. I think it was how to manage a loser, looking at rotten apples. I had sold a short naked put on Apple, thinking that we were probably close to a bottom within Apple a while ago. We weren't, and I don't even know if we're close to one now. But I had planned to roll that trade before options expiration last week. That didn't happen. I didn't get the opportunity to roll it, mostly because my account was just too drawn down. So I did take assignment of Apple shares at the price, and that's legitimately part of my strategy. When I sell those naked puts, I'm okay with assignment at that price come expiration day. Like that's part of the plan. Unless my thesis changes on the company, that's the only time I'll kind of maybe reconsider that plan. But like there has to be some really fundamentally shaking difference. Along with those, I also got assigned a bunch of Citi shares. I had been selling puts on Citi as Citi was falling. So Citi would go down $5, $10. I'd sell another 30 Delta put. It would fall another $5, $10. I'd sell another 30 Delta put. And that share was just very depressed. I got assignment on all of those shares last week as well. And I'm holding them. And I'm holding them planning to sell calls against them. Now, I haven't pulled the trigger on those calls. I actually want to kind of go through that example when I actually do execute on that. And the reason I'm holding these Citi and Apple shares, and there's some other ones in my portfolio, is fundamentally, I think banks will do well in a higher interest rate environment. They kind of got smacked around a little bit today because a lot of the chairman's comments were that a recession is very likely, a recession of some degree. And banks don't really like recessions because that's when the people that are borrowing money, that they're lending money to, it's where you start getting defaults and things like that. But this week marked the results of the bank stress test. So back from the financial crisis, there was the outcome of that was that banks needed to be stress tested annually. And the central banks come up with this test of, okay, banks, pretend that the market has dropped, 20% and bond rates are at X% and the unemployment is at, 12%. Anyway, they go through a bunch of simulations and they check how much free cash flow do those banks have. And if the banks don't have enough cash, then they basically have to capitalize themselves and give themselves more money. If they prove that they have enough, then they're kind of allowed to do things with that extra capital. That was kind of the outcome of the financial crisis. Well, all the banks passed with very, very good results just this week. And that means that I think the average was they had double the capitalization of the minimum. And the stress test this year was quite a bit more difficult than in years past because the forecast isn't looking so good. So they really dialed up the difficulty of the test. What does all that mean? That basically means come Monday, the banks are going to be allowed to decide what to do with this excess capital. They're not going to be regulated to hold it. Previously when the 2020 crash came, the government said, no, you got to cancel your dividends or cap your dividends. You got to squirrel away money. You can't do share buybacks, yada, yada, yada. All that is going to come off on Monday because of these successful results. So that essentially means that banks can redistribute some of their wealth to the shareholders. They can increase share buybacks. Every time you have share buybacks, you reduce the number of shares out there. All of this stuff is positive for banks. I'm very happy with the price point of them. So I am going to continue to hold my Citi shares and sell covered calls against them. That's largely where I'm at. I'm really, really not getting into a lot of plays. I'm very tight on my capital allocation right now. I really need to kind of start winning back some of my wounds from this entire first 2 quarters of the year. Well, Viper, that's pretty much my plan on trying to kind of claw back where I'm kind of sitting, not really committing. I'm still, one thing that I've done and will continue to do is weekly deposits. I can't, it's not really dollar cost averaging, but I strongly would recommend that everybody set if you want to get in the market, set some amount that you want to go in the market over some period of time, divide that up and just do weekly contributions to your brokerage account. I personally find that what you end up doing if you do that route is, one, you're not ever taking this big old chunk from wherever you are and dumping it in. But I also think you tend to go on less of a spending spree. And so I've noticed that the few times that I've pulled in chunks of money at a time into my brokerage account, I often will maybe buy or be a little bit more anxious to execute on those funds right away. Not as disciplined, whereas, if it's just kind of dripping in a little bit each week, there's never really enough to kind of execute on in any given week. Once you accumulated enough, you're kind of able to more patiently watch the market and pick your entry points and kind of get in there for that. And so I've been constantly dripping. And if we really start to at least sideways from here would be fine with me. But at least reduce some of this volatility. I should be getting back into action, I hope, with some more regular trades.
Yeah, so that's actually reminds me, that's a good point, because in my strategy now, because I'm in a different situation where obviously, so like everything you just said, it's not quite dollar cost averaging, but you're bringing that capital in to still be in there, and potentially it's at the ready over a period of time when you might need it at the ready. So one thing I've been considering is, obviously we talk about Think or Swim, TD Ameritrade all the time on here because that's what we like to use. I'm considering specifically for this VOO, VTI, any other ETFs that I want to truly dollar cost average into. I'm considering just for this portion of my portfolio using something like Robinhood, which does let you do scheduled deposits straight into a buy. So I could actually dollar cost average into these with an auto deposit, which, given my play of what's in front of me, really is enticing because it's just literally completely out of sight, out of mind. I don't even worry about, do we just lose 10% today? Like, because it's just that drip and it's dripping straight into what I'm trying to DCA into anyways.
Yeah, that's a decent approach. I don't know. Does Robinhood qualify for partial shares on those type of ETFs?
That's a good point. I need to look into that. I think they do, but yeah, I need to confirm because I did forget. I'm kind of in the spoiled crypto mind of like, yeah, just whatever you can afford, that's what you can buy.
Yeah, I think when it comes to certain funds and stuff on the market, that's one key distinction between ETFs and mutual funds. A lot of times the ETFs, you can't trade partial shares. You can only trade whole shares. Now, you can get awarded, I guess, partial shares from payback or things like that. But a lot of times it's the mutual fund type of product where you just give a dollar amount and then you get that portion of it. So that brings us to the end of this week's episode. Just some commentary on the general market. It's real interesting because a lot of times you get the summer doldrums where the market just really kind of sell in May and go away. It gets real quiet with a lot of the hedge funds and everything and traders kind of taking their vacations and not a lot of action. Not true this summer. There is quite a bit of action, quite a bit of volatility. Viper and I are hanging in there. We're looking to keep that drip, that dollar cost average going. We'll keep you posted as we make some of our trades and get into that. I hope you guys are hanging in there. I hope you guys are having decent luck and you're able to stay in the game and play the game. I'd love to hear what you want to hear about on this channel. Otherwise, good luck out there. And remember, think outside the block.